Hi everyone, thanks for joining. This is Sandeep. Anand. Most of the millionaires avoid this one mistake most of the time, and that is avoiding opportunity cost. Now, what is opportunity cost? We would have heard this term most often, and it is nothing but the cost of missing out on gains, mostly financial gains, due to a lost alternative opportunity. Now, why is this such an differentiating factor, an important factor that can make somebody richer or poorer or successful or not successful? It's because it cannot be seen. Opportunity cost cannot be seen. It cannot be perceived. It's mostly overlooked. And only in hindsight, we tend to realize after a few years, due to certain serendipitous circumstances or by chance, we realize, gosh, what did we miss? And it could be the other way also. The opportunity that you missed might have helped in a better way as well. Either way, in investing world, it's a very good idea to outweigh options that you have. And here's a real life example I have quoted, which could make somebody millionaire or poorer at the cost of an opportunity. Take a look. So there could be any examples, like it could be buying out things like gold, jewelry, uh, you know, art, whatever the case is. In this example, I'm taking the most common thing we all use is car. So for car, an average loan that we end up paying on a monthly basis for a new car is around $600. That's average. I mean, it can vary from price range and all of that. And for a used car, it is typically in the range of $300 a month. So that's a new car, which is you end up usually paying $600 a month, and for a used car, you end up paying $300 a month. Now, what is the opportunity cost of the remaining $300? Right. So if you have, say, if you invest that $300 delta, that is the delta between, and you end up paying for a used car, it's only $300. While if you end up paying for a new car in the same scenario, you might end up paying $600, let's say. So the gap is $300. Now, what happens if you invest this $300 in a balanced index fund over 5-year loan period? So typically you take car loans for 5 years on average. So if you, for that 10 year or 5 years, if you end up paying $300 every month, that's a delta. What's the opportunity cost of buying a new car versus a used car? So here is example. Now, if you go to the calculation, you could see that if you invest in the stock Nasdaq index, like let's say Nasdaq index, and the initial investment is starting. Suppose I'm buying a car 5 years back, 2015, and I put $300 that month. That is a delta. Then I add every month a recurring, investment of $300, which is ideally going to be paid. If you bought a new car, it would have been paid towards the debt or the loan, car loan. Now, if you, how many investments are you making over 5 year period every month? So 12 times 5, it's 60 installments or 60 investment periods, and you end up putting together $18,000 if you put month on month investments. And the total value, if you had invested this on a $300 on a monthly basis, install in a equated period, you might end up in the Nasdaq, the returns would have been over the last 5 years from 2015 till date. It would have been approximately $30,000, $30,500 approximately. Now, that is the returns that you're getting. So you almost double your money. Now, what would have happened if you had bought that car? That new car might be worth over the 5 years period, what something approximately that you ending up putting, say, 24 25K. The new car might be worth just half of that amount, or best case you maintain, it might be worth, say, 25K car might be worth around 16 17K. So what happens, the 25K, you end up, the 7K down payment and 18K loan is down to 16 17K, whereas in this scenario, that 7K, if you add it to the 30,500, it ends up being 37,500, 38K approximately. So you are gaining 20K over 5 year period due to investing in the Nasdaq index. That is the power of, that is opportunity cost that we are talking about here, and power of investing in the equity markets. And now this looks very small over a 5 year period. Now what happens is, if you are able to get a returns of 25 to 24 25 percentage over 20 years with this capital of 30,500 or 38K, you are looking at a whopping return of $3 million. Now, I understand for the used car, you might have ended up paying, that 7K still, and you might have ended up putting, say, 4, 5K more. Even if so, the case, you might be looking at, if you compound this for 25 percentage annual return over the next 20 years period in a similar return fashion, may not be index, could be stocks, you might be having a multiplying effect of almost 50 to 100 times. So you're talking about a minimum of $1 million, max of $3 million. That's the range. So a person who could have become a millionaire over 25-year period ends up having 18K with a depreciated car, a car that you can't even call as an asset. So that's the opportunity cost we're talking about. So opportunity cost should always be assessed in terms of the better alternative options, and delaying gratification helps there. Now, here is a small comparative study I've done between the two tables. What's the opportunity cost of buying a used car, and what is the opportunity cost of buying the new car? For the opportunity cost of buying the new car, we already discussed it's $3 million, approximately the max. Best scenario, worst scenario, $1 million over 25, 30 years. You could have ended up having a higher debt, and less savings. That's another opportunity cost. You will end up having less savings, and due to the debt. And third is obviously higher depreciation is an opportunity cost, because you're losing that out of the value of the thing that you're buying. Now, what's the opportunity cost of buying the used car? You might have a lesser experience than buying a new car. You might be doing a delayed gratification there, pushing it by 15, 20 years, and might end up buying a super luxurious car. Who knows if you're a millionaire? And third point is no social validation, no immediate social validation, and no immediate gratification. So that's where the comparative study, you have to do a typical example. Now, this is one of the example of a car. It could be applied to investing in a savings fund versus a mutual fund versus an index fund. Now, investing in an index fund, there could be opportunity cost if you wait against directly investing stocks. If well balanced 10 to 15 stocks might outperform the index by a lot of big margin. And so that is another opportunity cost. So you could always have opportunity cost comparisons even between stocks, growth stocks versus value. So you can always do this. And so it is very important to do opportunity cost analysis against all investing options that you have. That's pretty much I wanted to convey in this video. Hope this was helpful. Thanks for staying with me.